These Mag 7 hyperscaler businesses are losing profitability. They're now piling on debt, which is leverage. So you've gone from pure cash flow stock buybacks to highly levered and unprofitable. The market is, at some point, the market is going to realize, am I paying a multiple for? Why would I own that instead of something else? And as we'll get to, that something else at the margin is going to inevitably be Bitcoin. Bitcoin is really like one giant long-winded story of fixing capital misallocation throughout the world.
While headlines celebrate artificial intelligence as the next industrial revolution, a growing number of analysts are beginning to ask a far more uncomfortable question. What if the companies leading this revolution aren't actually creating value fast enough to justify the trillions being poured into them? What if the market's favorite trade is quietly becoming its biggest risk? For the past 2 years, Wall Street has rewarded anything connected to AI. Data centers are being built at a historic pace. Energy demand forecasts are exploding. Tech giants are spending hundreds of billions of dollars chasing what many believe will be the most important technology breakthrough of our generation. But beneath the excitement, cracks are beginning to emerge. Profit margins are shrinking. Capital expenditures are surging. And some of the world's most valuable companies are taking on increasing amounts of debt to keep the AI machine running. One of those urging extreme caution among investors is Jack Mallers. In a recent podcast, Mallers laid out a provocative argument that challenges one of the most dominant narratives in today's market. He believes investors are confusing a capital-intensive infrastructure boom for a software revolution. And if he's right, the consequences could be massive. Because when markets eventually begin questioning these valuations, the capital fleeing AI may need a new home. According to Mallers, that destination is likely to be Bitcoin. But Mallers doesn't stop there. He explains why many AI companies remain deeply unprofitable, why today's AI build-out resembles a credit-driven infrastructure cycle more than a technology boom, and why Bitcoin may ultimately emerge as the superior place to store wealth as this story unfolds. We'll break down all of it in today's video. If you enjoy content that cuts through the noise and helps you understand the biggest trends shaping Bitcoin and global markets, make sure to hit the like button, subscribe to the channel, and turn on post notifications so you never miss an update. Now let's hear Jack Mallers explain why the AI boom may be heading toward a reality check.
This is the greatest infrastructure build-out, at least nominally, in the history of mankind. Humans have never gathered to spend more capital on any given effort ever in our history. Fiber optic cables, railroads, the internet. This is the biggest ever. And so the question is everyone going to get paid back? Is there going to be misallocation of capital? And the reason, again, that this is relevant as Bitcoiners is because we are trying to educate the world that if you have capital that needs to be saved, okay, not invested, that implies counterparty risk, that implies a roadmap gets executed, that implies profits grow, that implies a payback schedule, saved, no counterparty risk, hard money, enforceable scarcity, self-sovereignly held on your own. We are on a mission to monetize the world on hard money. And when you have an investment wave that people misunderstand into competing with that, it matters to our mission. To people have said time and time again, AI's taken Bitcoin's throne, blah, blah, blah. It's obviously all bullshit. It's obviously all momentary and temporary. But that's why I think it's interesting, because it's all starting to fall apart. So first and foremost, this show is this is back to basics. You're not going to get a Harvard PhD listening to this show. I don't even have a college degree. So this is about basics, by the common man, for the common man, bring in finance and Bitcoin and some of these broad world topics to the streets, okay? Let's get to brass tacks. None of these AI companies that you know are profitable. I'm going to say that again. None of these companies are profitable. And I've said this before to you guys. To me, profit is a moral obligation before a financial obligation. Because profit really is, if money is value, which I think we all agree it is, well then by producing more money for your company than you spend, you are Literally, it is the financial expression of producing more value than you are consuming. It is the financial expression of making the world a better place. If making the world a better place was to be measured and denominated in value creation, then being profitable is the expression of that. And so this would be like a very libertarian, free market, Austrian economics way of thinking is producing profit is the goal because it is the way that the market is telling you you're doing good for the world. You are creating value. So, and obviously Keynesian economics and fiat and this mess that I was born into and that we live in today has greatly complicated this idea. You've got these companies that never plan on making profit, that infinitely raise money when when money can just be printed out of thin air. Well, then you get the master of all misallocations of capital, all malinvestment, because money is easy. If money's as easy as snapping my finger, then why do I give a shit about how it's invested, where it's invested? If I lose it, I'll just get bailed out. If I need more, I'll just print more. And so we've lost sight of just how really simple society should be governed. You need to make money. It's a form of Darwinism almost. If you're a business that is uneconomical, you should fail because we want the human energy and human resources and human capital to be focused on places that are productive. We don't want everybody wasting their time building something that's never going to be productive, valuable, and help us. Why would we want that? As sad as it is, shut your business down, do something better with your life, brother. Okay, so the first thing for you guys to understand, none of these companies make money. Supposedly, Anthropic claims they can be profitable by 2030. OpenAI has no path to profitability. Zero. I'll get to that in a second. XAI, Elon's thing, which is now rolled into SpaceX and stuff, they don't make money either. So the first thing to understand, which is critically important, is that none of these companies can finance themselves. Say that one more time. If you can't produce a profit, you are wholly reliant on somebody else to pay your bills, somebody else to finance the conviction that you have in the future. So these companies are all incredibly indebted to build out what I just told you guys is the greatest infrastructure build out in the history of humanity. But they don't produce any profits. So you now have borrowers. So when I say they're indebted, they're borrowing money. You have people borrowing money that can't pay off their own debt. They can only refinance their debt. Someone else has to keep financing them. They have to keep borrowing and refinancing just to sustain the business, or else the whole thing goes kapoof. And by the way, this is actually exactly why these companies keep raising private up rounds, is because as long as the equity keeps being revalued at a higher price, you can refinance your whole capital stack. But I dare these businesses to actually go public so that the public markets, which are ruthless, can tell you the truth and mark your equity down. And then the whole thing blows up because you can't actually pay with profit.
Mahler's central argument is surprisingly simple. He believes markets have become accustomed to rewarding growth at any cost, especially in an era where capital has been abundant and borrowing has remained relatively easy. The problem, according to him, is that eventually investors stop focusing on promises and start focusing on results. And when that transition happens, companies that rely heavily on outside financing rather than internally generated profits can suddenly face a much harsher reality. That concern leads directly into his second major point. While many investors continue to value AI companies as if they are traditional software businesses, Mahler argues they operate much more like massive infrastructure projects requiring endless capital, energy, and physical resources. And that distinction could have enormous implications for how these companies are ultimately valued by the market.
Now, the second lesson that you guys need to understand, brass tacks, very simple, is that AI is not a software business. AI, unfortunately, the markets are just now starting to understand this. We've been talking about on the show, a lot of the things we're going over today, we've been talking about on the show for months. So if you listen to the show, you got some serious alpha. But AI businesses are not like internet companies, because internet companies were fascinating business models because you had two core expenses. One, you got to plug your servers in somewhere. And two, you got to pay your engineers. But that's it. And you can have a fixed amount of engineers and the software scales infinitely. Just to get to, going from a million users to a billion users doesn't require the same amount of scale when it comes to engineers. We've seen now with AI and all of the cloud servicing and engineering, we've seen a group of 10 engineers scale software to a billion people because of things like the iPhone, because of the cloud. Okay. Now, AI is categorically not that business. Those businesses were the greatest businesses of all time. Meta, Microsoft. I mean, you have fixed expenses relatively and growing amounts of pure cash flow. These are insanely high margin businesses. You're selling products to billions of people and you're employing thousands of people. You're making tens of billions, hundreds of billions of dollars a year of pure cash. Okay, AI businesses are not that because they require physical build out. They're the opposite of low cost, high margin. They are extremely high cost because of the things on the screen. You got to build out data centers. You need GPUs, you need chips, you need electricity, you need cooling, you need power infrastructure. So instead of low cost, high margin, they are high cost and so far negative margin. These companies don't make any money. They're uneconomical so far. Now, obviously, the whatever Silicon Valley guy, if he were arguing with me and debating me at a conference, he would say, well, Amazon was this at 1.2. Like eventually though, Amazon was able to grow out of that and became one of the most profitable companies ever. It's a staple in society. That's all true. Fine, fair. But the point is that AI right now is priced as a software business, as if they get a multiple. Really, AI is like a real estate business or a physical infrastructure business that, has an app on the App Store as well. There was a very viral blog post that went around. Maybe, I can point you guys to it towards the end of the episode. It's a really long read, but it's very good, which says basically the AI bubble is much closer to the 2008 housing crisis than the dot-com era. The dot-com era was just, everyone was way too exuberant and excited about these technology equities and gave them far too much multiples, were way too optimistic about the future and the cash they'd be able to produce, and gave them the benefit of the doubt that they'd have easy revenue models and easy monetization streams that they'd be able to implement, and just got way too exuberant. And the equity just had to be marked down. The AI stuff is very different because none of these businesses produce profit, and they're building physical, literal infrastructure. Like they're building physical data centers, taking over land, like needing to invest in they're spending trillions and trillions and trillions of dollars as an industry. That money is all borrowed, uncollateralized. That's not like buying an equity and having it get marked down. And you're like, well, shit. I'm still bullish Amazon. I'm going to hodl. I'm going to keep. No. You're borrowing. This is uncollateralized. This is like what happened in the housing market. This is a physical industry. Okay. So I created this meme. AI has always been a cost-intensive business. So the meme is AI is more of a credit-driven real estate cycle than a technology cycle. And the guy pointing the gun, it always has been. It always has been, guys. It always has been. You're starting to see the Mag 7 multiples compress because they're going from software businesses to physical high-cost businesses. These Mag 7 hyperscaler businesses are losing profitability. They're now piling on debt, which is leverage. So you've gone from pure cash flow stock buybacks to highly levered and unprofitable. At some point, the market is going to realize, am I paying a multiple for? Why would I own that instead of something else? And as we'll get to, that something else at the margin is going to inevitably be Bitcoin. Bitcoin is really like one giant long-winded story of fixing capital misallocation throughout the world. Oh, you meant to save money for your future, not to take a highly levered physical infrastructure AI bet? Oh, shoot, you were meant to invest in Bitcoin, not in OpenAI Series E2.
Whether you agree with Jack Mallers or not, his analysis forces investors to confront an important question. Are today's AI leaders being valued based on what they are currently producing, or on what investors hope they will eventually become? History is filled with examples of transformative technologies that changed the world while simultaneously destroying enormous amounts of investor capital along the way. Being right about a technology doesn't automatically mean being right about its valuation. Mallers isn't arguing that artificial intelligence will fail. In fact, his point is almost the opposite. AI may very well reshape industries, increase productivity, and become a foundational part of the global economy. The issue is whether the financial rewards from that transformation will be large enough and arrive quickly enough to justify the staggering amounts of capital currently being committed to the sector. His Bitcoin thesis emerges from that distinction. If investors begin questioning leveraged infrastructure bets and increasingly seek assets that don't depend on management execution, debt refinancing, profit forecasts, or future cash flow assumptions, Bitcoin becomes a very different proposition. Unlike traditional investments, Bitcoin doesn't need a business plan, quarterly earnings report, or successful rollout strategy. Its value proposition rests on scarcity, ownership, and monetary certainty, and that's ultimately why Mallers sees Bitcoin as the potential beneficiary of any future reassessment of AI valuations. If capital has been misallocated on a historic scale, then markets will eventually search for assets that offer a clearer and more reliable store of value. Whether that scenario unfolds exactly as he predicts remains to be seen, but it's certainly a perspective worth considering as the AI boom continues to accelerate. What do you think? Is Jack Mallers right that the AI trade is beginning to resemble a credit-fueled infrastructure bubble, or will artificial intelligence ultimately justify today's massive spending spree? Let us know in the comments below. If you enjoyed this video, be sure to like, subscribe, and share it with someone who follows Bitcoin, technology, or the broader financial markets. Don't forget to turn on post notifications so you never miss our latest analysis. Thanks for watching, and we'll see you in the next one.